Equity mutual funds, meantime, burning through cash. Believe it or not, fastest rate in 18 years with their cash reserves, the smallest since 2007. Will the S&P 500 rally run out of steam? Well, let's put that question to Mark Luschini, Chief Investment Strategist with Janney Montgomery Scott, which is more than $50 billion under management. There he is joining us live with his read on where stocks are headed. Great to see you. So let me first ask you about this cash burn in the mutual fund industry, Mark. Is it significant to you as a strategist?
Well, good afternoon, first of all. And yes, it is. At this point in time, if you look across equity mutual funds, you would have to surmise that portfolio managers have, at this point, chewed up a fair amount of dry powder. And with fairly low levels of cash, in order to pump equity prices higher, they would require an infusion from some source to be able to have them be buyers of stocks and drive bid prices higher than above today's levels.
So bottom line, does this mean that you've got a more bearish look to the S&P 500?
Well, not necessarily, because I do think that there are other potential sources of cash for portfolio managers. One, of course, might be foreign investors. Another might be pension funds reallocating to expose a higher portion of their portfolio to stocks. And, of course, last but not least is the much trumpeted $3.2 trillion that resides in money market funds that are yielding less than 0.5%. And as a consequence, that money is being forced out of money market balances in search of better returns. And part of that destination for those returns may come in the form of equity mutual funds.
Well, Mark, having said that, are you surprised at how skeptical investors have been up to this point?
It is interesting. We saw the last time we had a rather significant bear market, which was 2000 to 2002, that investors kind of embraced the notion of buying on dips and were quick to come back to the equity markets. We're not seeing that so much this time. I mean, here equity prices from the lows in March of 2009 have marched some 70% higher approximately, and yet investors remain highly skeptical about this recovery in equity prices. And I think that has a lot to do with the still heightened level of uncertainty that exists out there. I do expect that that sentiment will eventually fade, but for the time being, it is somewhat interesting to see consumer attitudes and investor attitudes with regard to U.S. stock funds and stock prices.
And Mark, I would imagine that even perhaps more astounding when you see some of the numbers, the monthly figures that come out, and it seems that things, at least on the surface, are starting to stabilize. But folks, they want to see more than just a month over month. They probably want to see quarter over quarter improvement before they decide, well, now's the time for me to jump in.
Well, I think you're correct. I mean, we've had some sequential quarters of profit growth. It hasn't necessarily showed up in revenues quite as much as yet, but I think you need to get some reinforcement on that front. I think the still relatively high unemployment rate is troublesome for investors as they're looking at that and wondering about their own job security, let alone what the future holds in the labor market. And so that's enough to keep people sidelined. That said, I do think if we continue to see improvement in the equity markets, that will serve as a magnet to investors that are frustrated by the abysmal rates of return that they're earning right now in their low-yielding money market funds, CDs, or savings accounts.
So what kind of advice do you have for investors in U.S. equities? I know you're overweight industrials, technology. Let's start with those two industries. What's going right here?
Well, I think a couple of things. One, of course, in general, you've had a weakened dollar. Although the dollar has rallied since the end of 2009, it's still well below the highs we saw as little as 6 months ago. And that's helping their international businesses greatly. In addition to that, these industries are largely geared towards overseas markets. And as we know, growth from areas like emerging markets, China, India, Latin America, is much in excess of that of the United States. So they're benefiting from that accelerating growth pattern in overseas markets. In addition, these two sectors have done a terrific job of being very aggressive in cost cutting. They've been able to maintain their margins, their profits are increasing, and if we see any recovery whatsoever in revenues, they're highly leveraged to have that realized in the even greater profit growth going forward.
And if you're underweight consumer discretionary, like so many people are in these economic times, what signs are you looking for, whether it be a market level or an economic data point, i.e. the unemployment number, would you look for, again, to get back into this industry?
Well, I would look at a couple of things. I mean, it's well known that unemployment is largely a lagging indicator. But if you look at things like initial job loss claims, if you look at housing prices and stabilization coming into that market, I think those two data points, if you will, serve as a litmus test for prospective increases in consumer confidence, which will then lead to spending. At the moment, there are some pretty significant headwinds to the U.S. consumer, and as a consequence, as you had mentioned, why we remain underweight that discretionary sector, which is comprised of the retailers and the automobile manufacturers and the restaurants. So as we see those data points like the jobless claims numbers and or housing prices begin to improve, readings on consumer sentiment begin to improve and sustainably improve, then we'd be more inclined to be a little more biased towards those discretionary sectors than we are today.
All right, very good. Thank you so much, Mark Luschini, the Chief Investment Strategist at Janney Montgomery Scott. Sure appreciate your time this Monday afternoon.